one of the things that's often discussed with reinsurance and why it's an interesting asset class is this idea that it's a non-correlated asset class. And I wondered if you could dive into that, what that means a little bit for the audience.
Yeah, so when we talk about correlation here, we're talking about whether a set of things are expected to behave in a similar way. The things in this case being usually prices or the value of something. Now, in the case of most companies and most businesses, they are very tightly tied to the economies that they operate within, because their customers, whether they're corporate or consumer, tend to spend less on their services or similar if they're in a recession than they would during an optimistic growth period. So typically all of those stocks suffer during a recession. If you look, though, at a different type of value and you're valuing the risk of something, so with a stock, so with a corporate stock, you're valuing the risk of that company's future success or future failure in the price that you assign to that stock. If you're looking there at the value of pure risk, in the sense of will an event happen, you start to be able to explore insured or sometimes less insured events by talking about, for example, natural catastrophes and saying, how likely is it that the wind will blow or that a hurricane will pass through this particular set of states in the US, or that an earthquake will occur in California? And those types of things are not impacted by the prevailing economies in terms of whether or not they will happen. Yeah. So for that reason, we call them non-correlated assets. And if you're able to set up vehicles, be it through an equity base of, relying on insurance companies who rely very closely on those types of things, you can use that. But there's also debt instruments that focus specifically on that, like catastrophe bonds, insurance-linked securities more generally, that try to give people who want to invest in risk the opportunity to get exposure to these non-correlating asset classes. So if your portfolio as an investor or a pension fund or anybody really contains mostly stocks, then during a recession, your portfolio is going to reduce in value most likely.
Yep.
However, if you've got a bit of non-correlating insurance risk in there, then the probability is that those prices will stay the same, on the same trajectory that they were on, regardless of how the economy is performing.